I think a lot of metals analysts are expecting an intermediate top in gold at 4,000 and an intermediate top in silver at 50. I'm of the opinion that the rally may go further than that, and I'll explain why in this video. So I'm going to start off and show you the dollar. This is the chart of the dollar, long-term chart of the dollar. It started a secular bear market right here at this peak, and this is a daily chart, so this is the 200-day moving average, but price is also below the 200-week moving average, and that's kind of my tool that I use to determine if an asset is in a secular bear market, is if it's dropped below the 200-week moving average and that average is starting to turn down. That's usually a fairly dependable sign that you're in a long-term, multi-year bear market, which I think the dollar is. Now, here's why I don't think this intermediate rally in metals is going to stop at $4,000 gold and $50 silver. Now, it may have a minor pullback, what I call a daily cycle low, but those don't last very long. They're usually somewhere between 4 and 10 days. They'll drop below the 10-day moving average, and they'll turn that average back down. But we're not talking about a correction that lasts 10 or 12 weeks. This is just a very short-term pullback, kind of clears some of the short-term sentiment, and then basically as soon as it gets a little bit oversold, then it starts to rally again. That's what I think is going to happen, and this is why. So this is an intermediate degree bottom, and this is an intermediate degree rally. This is also an intermediate degree rally. But you can see the difference between this rally here and this rally. So this is a major support zone here. It's right at around 100. It initially broke, and this is not unusual when you get a break of a support zone or resistance zone. But if it occurs late in a cycle, it generally doesn't produce a sustained move, and that's what happened here. This intermediate cycle was really late, and so the breakdown occurred very late in the cycle, so it did not produce a sustained move. It bounced pretty quickly, and we got another left translated intermediate cycle. So basically it's making lower highs and lower lows. And because this cycle was really long, this one was a bit short. And then now we've got another intermediate bottom here. And you can, in the long-term chart here, you can see what happened. This rally got right up to this resistance zone and failed. And it's a little bit difficult to see on this longer term chart, but this was our first daily cycle, this was our second daily cycle, and this was a left translated daily cycle, which means it topped on the left side of center. So let's say if a typical cycle is 20 weeks long, if it tops on say week 4 or 5, that would qualify as a left translated cycle. And what that means is it just has a lot more time to move down. And what generally happens, not 100%, but what generally happens is when you get a left translated cycle, because it has more time to move down than it did to move up, it will generally make a lower low below the previous cycle of that same duration. And you can see in this case, not only did it drop below this pivot right here, but it also broke below the intermediate cycle low right here. So I'm seeing analysts predicting that the dollar is going to rally, and it will, but I don't think, not yet. This intermediate cycles is a bit too short. We're only on week 13, and this short cycle here balanced out this long cycle. So I would expect a normal duration cycle, something that's going to last 20 to 25 weeks maybe. So at a bare minimum, I think that this daily cycle here, it looks to me like it's trying to roll over and left translate, just like this one, left translated, came down, made lower lows. The expectation is that this rally out of this daily cycle low also is not going to be able to make a higher high above this pivot here, and it will eventually make a lower low. And one of the things that I think these analysts that are predicting a dollar rally are missing is the dollar was already starting to anticipate rate cuts. And then we get the rate cut, but we've got another rate cut. It's almost a sure thing at this point. I think the odds are at 97%, and anytime the odds are 75% or more, then the Fed will follow what the market tells it to do. And so if the futures are predicting a 75% chance that the Fed's going to cut on the October, I think it's 29th FOMC meeting, then the Fed's not going to go against the market. The Fed will do what the market tells it to do. And if the market tells it to cut, it's going to cut. And so right now, the odds are about 95% or greater that they're going to cut. So the dollar is just not going to rally with that headwind. More than likely, it's going to continue to anticipate that cut, and it's going to break down here. At the best case scenario is it goes sideways, but since we already got a failed cycle right here, and we poke below that, usually what happens, you poke below it, you get some buyers that buy on that breakdown, and you rally, but you don't rally. There's not enough buying pressure to make a higher high, and then it comes down and it tests it again, and eventually it breaks below it, and you get another leg lower. I think that's what's going to happen between now and the FOMC meeting. And then at the October FOMC meeting, where they cut another 25 basis points, that's the point where I think you have a realistic chance of getting some kind of sustainable rally, another multi-week rally like this or like this. But again, because we're now in a secular bear market, we're not going to go back above this peak. This is a new 3-year cycle, and it has rolled over and made lower lows. So we're in a secular bear market. The intermediate rallies are probably going to continue to come up short, not be able to make higher highs. So you can see this one didn't make a higher high. This one didn't make a higher high. Suspect we'll come down here somewhere, make our intermediate bottom around the FOMC meeting, and then we'll rally. But again, we won't be able to get above this peak. And my expectation is that this secular bear market in the dollar is what's going to be driving the final bull market move in gold and silver. And let me go over to those charts. All right, I'll start with a long-term chart. You can see, pretty clearly the cup and handle pattern. This was an 8-year cycle low at the end of 2015. This was our next 8-year cycle low here at the end of, I think it was October of 22. It formed the lowest point of the handle, and then I noted this last year that the banking cartel was trying desperately to push gold back below 2,000. When that failed, it unleashed a short squeeze in the gold market, and you can see what that short squeeze has done. This has been an incredibly violent and aggressive rally. We haven't even really gotten any kind of major pullbacks. The intermediate degree corrections have all unfolded as sideways churns. That's because the banking cartel is having to cover the shorts that they're trapped into quickly, and so we're not getting the regular ABC corrections. We're just getting these sideways churns. And based on the size of this base, this cup and handle base, this is what are we, 13, 14 years, something like that. We got a long ways to go. And I think most people know the rule: bigger the base, the higher in space. And we are not even remotely close to finishing this rally out of this massive 13-year base. And this is why I say 10,000 is going to be a piece of cake, and we could even go above that. 15,000 is not out of the question, maybe even 20,000 not out of the question, but just, predicted by the size of this basing structure. All right, so as I said when I started the video, I think a lot of people are expecting that this is going to top at 4,000 and silver is going to top at 50, except I don't think they're taking into account that dollar cycle is probably left translating and is probably going to continue generally down, at least into the FOMC meeting, where they're going to cut another 25 basis points. So I think what's likely to happen, because we're already within spitting distance of these numbers, I think we could hit $4,050 next week. And then you still got a lot of weeks left before the FOMC meeting. And also, it may not be the FOMC meeting that is the trigger event for the dollar to bottom. It might be the employment report. Since the government's shut down, we didn't get a employment report for October. And so we're going to have to go another month before we get another employment report. So that may actually be the actual trigger event would be on November, I think it's November 7th, instead of October 29th. So the dollar may not bottom on the FOMC meeting. It may wait until we get the employment report that first week of November. And so that gives us like another 5 weeks or so to go. So if we get to 4,000 and then we pull back into a minor daily cycle low, as I was saying, one that lasts 4 to maybe 10 days, and then the dollar continues to fall, then that's a driver to push price above 4,000 on gold and above $50 in silver. And I could make a case that if assuming we do get to 4,000, then that's a 500-point breakout from this $35 or $3,500 resistance zone. So we broke out, assuming we get to 4,000, we broke out, 500-point rally, then we get a minor daily cycle correction for a few days, maybe a week, and then potentially another 500 points that could take gold up to the 4,400 to 4,500 range before we get an intermediate correction. And I've gone over in another post, I noted that every breakout from these sideways consolidations is tacked on at least 14 to 25%, and that's going to put gold, if we assume a similar duration or similar magnitude rally, that would put gold right in that 42 to 4,500 range for this breakout and rally. And again, same thing, bigger the base, the higher in space. 4-month rally, I don't think it's going to end at 4,000. I don't think that's enough. That's not enough of a move for the size of this base. So the combination of, I doubt that the dollar is going to bottom until the end of October and maybe even the first week of November. The fact that this rally has not gone far enough yet on predicted by the size of this basing structure. And just that I think a lot of people are planning on selling at 4,000 and at 50, and it's probably initially going to look like they're right, because I think that's a level that's probably going to stop the advance, at least temporarily. But then when it resumes and breaks out, all those people that sold are going to have to chase, and all those chasers are they're the fuel to drive this to, for gold, to drive it to 42, 43, 4,500 before this intermediate cycle tops. And then at that point, we either get another one of these, although I don't think we will. I think the next one's probably going to be more like an ABC move, something that's a little scary. At $4,500 gold, we would be stretched insanely far above the 200-day moving average, and we're probably going to need a more typical kind of correction than this sideways. The other factor I'm looking at is that we're 3 years into this 8-year cycle, and as you get further above the moving averages, then these sideways churns have to last longer in order to allow the moving averages time to catch up to price. So this one lasted 4 months. If we get up here to 4,500 and then we have to go through another sideways churn, you're talking probably 6 to 8 months. And as I think we're going to get our bubble phase during this 8-year cycle, I don't think we have time to waste 8 months on a sideways churn. So I think more likely is we get to somewhere between 43 and 4,500, and then we get, an A, B, C move, and something that comes back down and gets closer to this 200-day moving average, scares everybody, knocks out all the people that bought, chased up here at the top, all the retail traders, especially if you go above 4,000. We're already starting to see retail traders taking notice of gold. And if we get above 4,000, we're going to have a lot of retail traders chasing that. We need to wipe those people out. I think there's a good chance that could turn out to be the half 8-year cycle low. That would build the fuel and set the stage for the final parabolic move that could take us to 10,000 or higher by maybe late 2027 or early 2028, which is, I think, the timing band for the dollar to reach its next 3-year cycle low, I think, is in late 27 or early 28, and that would be the ideal spot for gold to give us a final parabolic move into a long-term secular bull market top, a bull market that started in 2000 and would end presumably in like 2027 or 2028. So that's what I think is likely to happen. We'll see if it plays out, but I think we're going to get a correction from 4,000 from 50, but I don't necessarily think that's the end of this intermediate rally. I think we may fake everybody out with a minor correction and then another run higher as the dollar completes that drop into an intermediate cycle low.